There is a mechanism in markets so reliable, so well documented, and so consistently ignored that its rediscovery in every cycle is itself one of the great recurring events in financial history. It is called the capital cycle. And right now, it is operating at full force. You can see the backdrop in a single chart. American equity valuations, measured by the cyclically adjusted price-to-earnings ratio, sit near the highest levels in over a century. Territory reached only in 1929 and in 2000. The logic of the capital cycle is elemental. High returns attract capital. Capital floods an industry. Supply expands. Competition intensifies. Returns compress. And capital, eventually, retreats, leaving behind overbuilt infrastructure, impaired balance sheets, and a generation of investors who paid peak prices for assets whose economics were being quietly destroyed by the very capital they committed. This is not a controversial idea. It is simply what competitive markets do to capital over time. Excess returns invite imitation. Imitation creates overcapacity. And overcapacity destroys the excess returns that attracted the capital in the first place. The pattern is everywhere in history. The British railway mania of the 1840s, the American railroad booms, the global shipping bubble, the shale oil revolution, and, most vividly in living memory, the fiber optic build-out of the late 1990s. The technology boom that became the dot-com bust. Look at what happened to the returns. Measured over rolling 10-year windows, the Nasdaq delivered some of the greatest gains in market history into the year 2000, and then gave almost all of them back. The technology was real. The investment returns were not. Edward Chancellor, the financial historian who has done more than anyone to codify this framework, puts the point simply. Most analysis focuses on demand. How big will the industry be? How fast will it grow? But the right question is different. The right question is, what is capital doing? Because supply is the signal. Which brings us to today. The numbers around the artificial intelligence build-out are, even by the standards of historical manias, extraordinary. In 2025, 60% of all American venture capital flowed into AI. Startups raised over $200 billion in a single year. And the hyperscalers, Microsoft, Alphabet, Amazon, and Meta, have committed to data center spending in the hundreds of billions of dollars a year. You can see it in the national accounts. Capital expenditure on information and communication infrastructure has gone vertical, reaching levels that dwarf anything in the historical record. The framework does not require an opinion on whether artificial general intelligence arrives. It requires only one observation. The quantity of capital now being deployed is of a magnitude that, in every comparable episode, eventually produced supply that exceeded demand. The railroads bankrupted their investors. The fiber optic boom destroyed roughly $2 trillion of invested capital. In each case, the transformation was real, and the returns were not. Chancellor identifies the structural fingerprints of a mania near its peak. Narrative displacement, a story about the future replacing analysis of the present until no price seems too high. Competitive intensity without differentiation, every giant racing to deploy capital as fast as possible, building near identical data centers to run interchangeable models, and crowding out. Crowding out is the most useful idea for an investor. When capital floods one sector, it abandons every other. In 1999, the old economy stocks, energy, materials, industrials, were priced at historic lows precisely because capital had stampeded into technology. The same thing is happening now. Watch the weight of the energy sector inside the American stock market. From over 20% in the early 1980s to a thin sliver today. The mirror image of that collapse is the rise of technology. Capital has concentrated into a single theme to a degree rarely seen in market history. But the capital cycle is not the whole danger. What makes this moment more fragile than most is leverage. Margin debt, money borrowed to buy securities, reached a record $1.18 trillion in late 2025. The investor credit balance fell to its lowest level ever recorded. Investors collectively owe more than they hold in cash. And the pace matters. Year-over-year growth in margin debt recently ran near 39%, structurally elevated by any historical comparison. Why does this matter? Because margin debt does not merely signal optimism. It builds a mechanism for amplifying any decline. When prices fall, margin calls trigger. Margin calls forced selling. Forced selling drives prices lower, which triggers more margin calls. That cascade is not a tail risk. It is how leveraged markets break. It happened in 1929, in 2000, in 2008, and in early 2020. Here is the hardest part. The framework tells you what will happen. It cannot tell you when. As Keynes is supposed to have said, markets can stay irrational longer than you can stay solvent. A short position in the Nasdaq opened in January 1999 on entirely correct fundamental grounds would have lost everything before the thesis was vindicated in March 2000. Vindication arrived. The investor did not survive to enjoy it. The capital cycle is not a timing model. It is a valuation and risk framework. It tells you that the structure is unsustainable, not the date on which it breaks. But the cycle's destruction of returns is not the end of the story. It is the beginning of the next one. The railroads that ruined their Victorian investors became, after consolidation, highly profitable. The fiber optic cables that obliterated 1990s telecom fortunes became the backbone of the internet, bought for cents on the dollar by those who came after. The shale producers who went bankrupt re-emerged leaner and finally earned the cash flows the original thesis had promised. So where is the opportunity now? Chancellor's framework points consistently to the sectors that today's cycle has depressed: energy infrastructure, industrial commodities, international value, the old economy stocks of the technology cycle. Copper, above all. A decade of underinvestment in new mines, driven by the poor returns of the last commodity cycle, has left the world structurally short of the metal that both the energy transition and the AI build-out require. The capital cycle that destroyed commodity investors in 2015 has set the stage for the next supercycle. There are honest risks to this view. AI may prove genuinely discontinuous, breaking the historical pattern. And the cost of capital matters. After years of suppressed real interest rates, valuation comparisons are harder to make. But none of this invalidates the framework. The neglected sectors, metals and minerals, energy and base metals, sit at the opposite end of the capital cycle from the AI trade. The capital cycle is not a moral judgment. It does not punish greed or reward caution. It is a mechanical process, the response of competitive markets to price signals. The current AI cycle is its clearest expression since the late 1990s. The technology is real. The transformation is genuine. The capital is excessive. And layered on top sits a record in borrowed money that creates the conditions for a violent correction when sentiment finally turns. The cycle always completes. The only question, the one every investor eventually faces, is whether they will still be solvent when it does. This is Game of Franks. The full article, with the charts, the data, and the methodology, is at gameoffranks.com. Subscribe for the next one.